Have Laura McKay with us today. She's a co-founder and chief operating officer at PolicyMe, and we're here to talk about financial or family financial basics with a focus on life insurance and why it's so important for a young family. Welcome.
Yeah, thanks for having me. It's great to be here.
Yeah, it's great to have you. So, we'll just start with some different questions we put together, things that we hear a lot from our customers with just questions about life insurance in general. So, why don't we start with the basics? What is life insurance and how does it work?
Yeah. So I like to describe life insurance as like a financial promise between you and an insurance company. So you pay monthly premiums or annual premiums, and in return, they promise to pay your loved ones or your beneficiaries a tax-free lump sum if anything were to happen to you. So if you were to pass away. So it's meant to really be there as a kind of security blanket if for any reason you lose a loved one in your life, and it can help pay for some of that lost income or pay down your debts, pay off your mortgage if anything were to happen to your partner in your life. So it's a pretty important financial instrument. Most people, by the time they get to kind of mid 40s, if they have a partner who depends on their income or kids who depend on their income, really start thinking about, okay, what would happen if anything were to happen to me? How would they be able to protect their lifestyle? And that's when they start thinking about life insurance and kind of the importance of it.
Yeah, not the most fun topic, but very important. And actually, I think this is a great place to start because there are different types of life insurance. So, what is the difference between term life insurance and whole life insurance?
Yeah, so typically you break down life insurance into two categories. So it's actually term and permanent life insurance are the two main ones, how people think about it. Term is exactly what it sounds like. It's only for a set number of years. So usually it comes in the form of like 10 years or 20 years or 30 years, sometimes even 15 or 25. And that's basically life insurance that will end one day. So essentially you get it during the years where you have dependents where you're still working, you still have an income, your household still depends on your income to like manage their weekly finances. And so it's for that period of time when you're in your working years. And then it ends. And then essentially at a certain period after those 20 years or 30 years, you no longer have the life insurance anymore. Permanent life insurance is it's for life. It goes on for kind of until you pass away, no matter what that age, whether that be in your kind of like 80s or 90s. It typically it can be a little more complex in that it has like a financial or an investment component to it. It tends to be used in more complex, like estate planning needs, maybe for some like tax strategies. And it tends to be much more expensive than term life insurance. It can be kind of like 8 to 10 times the cost, and can get pricey, specifically into your older years when you may like be depending solely on like retirement income. So, I mean, the obvious question is kind of what makes sense for people. We typically advise people that you need life insurance during your prime income earning years when you have dependents who are relying on that income. So, say you have kind of young children or you have a large mortgage that really was kind of like you bought your house assuming both your incomes would be used to pay off that mortgage. That's the time when you're at most at risk of losing kind of that financial income stream. Once you start entering your retirement years, I mean, by definition, you decided you no longer have to earn an income. You are solely living off your kind of retirement savings. So life insurance makes makes less sense as like an income replacement strategy. That's where you start moving into more complex like tax optimization strategies. And for most people, that's not like what they need. What they need is kind of that affordable product that's around $30 a month in those really young, in those years where you're kind of like your risk is at its highest, your kids are super young, like your mortgage is at its highest, and that's why we strongly believe for most Canadians that term life insurance is the product for them.
That's great. So how much insurance do I need?
Yeah. I mean, it's a very personal decision. There's a lot of like back of the envelope, like simple calculations you can do that are like 10 times income, or some people will say 5 times income plus your debts. There's lots of personalized calculators, even on our website at PolicyMe.com. You can go and check it out and get like a personalized advice engine if you want a more complex like calculation. So it depends. I would say for most people, it ends up falling in that range of kind of like 10 times income plus your debts. It like there's a lot that goes into it depending on whether you plan on paying for like your children's cost of education, for example. You might want to factor that into your life insurance needs. So there's no one size fits all. You're looking at, an average Canadian. What we see is like the average life insurance policy can be anywhere from like $400,000 to $700,000 of life insurance. But again, it's a pretty personal decision, and the calculators online are very simple to use. They take 5 minutes. So plugging in your details, you can get a good recommendation on what you need.
Yeah, that's great. And again, obviously everyone has very different needs. So how much does term life insurance cost?
Yeah, so term life insurance, the way an insurance company thinks about pricing a product like that is really just what's the likelihood, like what's the risk involved, right? So term insurance, all life insurance is cheaper depending on your age. So it's more affordable when you're younger. So in your 30s, if you're looking for a policy that's maybe like $500,000 of income, you're probably looking somewhere around like $30 a month. So pretty affordable product. As you age, that price can go up. So essentially, like I would say it can go up to maybe $40-$50 a month, but it's a fairly affordable product if you're just looking to cover yourself during those kind of like 20 major years where your debts are at its highest and your children are still young.
To understand the pricing, does the price go up while I have the term insurance, or is the price set when I sign up for it?
Yeah, so it's set when you sign up for it. Well, it depends on the insurance products. But the ones on PolicyMe.com are like flat level premiums, meaning they don't change for the whole term of your product. So once you lock in a price, it will stay that price for the full 20, 30 years, etc. So it's definitely wise when you're, a bit younger and your insurability is good to kind of lock in that rate then.
Yeah, makes a lot of sense. Another question just with regard to the pricing. If I, for example, I'm not 30, but if I was 30 and I thought this was the right amount for me, I signed up, I don't know, $200,000. I signed up for a term life insurance. Am I able to sign up for a second term while that one's running, or am I able to increase what my policy is during the term?
It's one a lot of people have. So decreasing is easy for insurance companies. I come from an actuarial background, so I can kind of like think about the risk against the pricing. And so decreasing is always easy. Increasing is a bit more tricky because there's a lot of anti-selection that comes into increasing. Perhaps, you find out something about yourself and all of a sudden you want to double your insurance. So insurers will typically require you to go through underwriting again if you want to increase. So there's no issue. You can buy a new policy, but you don't just have a feature that allows you to add on at any point, regardless of your life circumstances. They will ask you to go through and go through medical underwriting again,
Right.
which depending on your circumstances could make you eligible or ineligible for life insurance. So we typically recommend, to lock in kind of what you need right away. And if there's periods in your life, if you have another child, or if you kind of move into a larger home or something, that's where you can think about scaling up and applying for a new policy. But trying to think of those things a little bit sooner in the present
Yes,
is
makes
helpful,
sense.
just
Makes
in
sense.
case something happens with your insurability that makes it more difficult to get more insurance later on.
So
Yeah.
thinking about a family, if there's two-parent family, should both parents get life insurance?
Yeah, I think most of the time both partners are applying together. So we've actually on PolicyMe realized that really early on that people like to buy life insurance as a couple, and built a pretty seamless kind of a joint application. We even give a discount for people applying together so that they can just get it at the same time, know they're insured. When I see couples who, maybe think they need different amounts is when you have big differences in maybe the income they're bringing in. So if you have one breadwinner in the family, they may think okay, this is going to be a serious financial impact if one of us were to pass, or if the breadwinner were to pass away, and you might see that person look for a little bit more insurance than their spouse. But I would say for most couples, about 80%, at least what we see, are applying for the same amount together. They just are kind of defaulting to the same coverage amount. They feel at peace knowing that, certain debts will go away no matter no matter what happens to either of them,
That's great.
Yeah.
And should I get life insurance for my child?
Yeah, so this goes back to kind of my principle as to what the purpose of life insurance is. Typically, I think of it as an income replacement vehicle. It means that someone in your life, some dependent, some beneficiary, some loved one, is dependent on your income. And if your income were to go away, they would have a major loss. They wouldn't be able to afford their lifestyle anymore, right? So most people go into a partnership and they're making big purchase decisions like a house with the thought that both incomes will be there. And if one income goes away, that the family is left in a very serious impact, right? Because they've built their lifestyle around both these incomes. A child is different, right? There's no if said child is below the age of 16, 20, whatever age, it's unlikely that the family is dependent on their income to kind of make their mortgage payment, for example. So it can be sold in the industry in the form of kind of a funeral insurance. It's not something we sell. It's not, we add a free child rider to our policies, $10,000. It's covered. We think that's kind of all you need for your children. You don't need a big $200,000 policy per child or anything like that. So we've kind of made that decision a little bit simpler for families, and that we just say it's free child coverage, all your children are covered, and then you don't have to think about it. You don't need separate policies for them. They're just embedded in your coverage.
That's really interesting.
Yeah.
So a lot of people will say, well, I have benefits at my company. I get life insurance through work. Would I still want to think about, getting an additional life insurance policy?
Yeah. Yeah, so I think this is actually an interesting question because a lot of people are very mystified by some of the benefits they get through their work. So I would encourage anyone to just take a look, ask. I'm sure it was available to you when you first joined the company or during some annual enrollment period. But usually what's on average people are getting are about a 1 or 2 times income. That's what we see most commonly. I mean, it could go up a little bit higher, but most corporate company employment benefit plans are including 1 to 2 times income. And if you just think about your life, if you just put yourself, you're a young parent, and you have a couple kids, you have a big mortgage, 2 times income or 1 times income of your spouse after they pass away is it's not enough. Like it really is just going to still leave you in a place where you might have to sell your home. You might have to really downsize. You might have to think about kind of moving to a different city because you can't afford that cost of income cost of living anymore. So it is a good starting point and it's a good benefit and people shouldn't discount it. But it's certainly what we encourage you to do is to like learn about what you have and then just make a decision personally if that's enough. And most people are supplementing their current corporate policy with an individual policy on the side. The other thing that's a bit of a downside to corporate policies is that they tend, and this is where reading the details is important, but they tend to not be like portable, meaning if you leave your employer, you might lose your coverage. And it's important to think about this in life insurance because your insurance eligibility is important, and you may not have it forever, right? You may go through a period where your health deteriorates in some ways or you have a really scary health scare. And if at that point you also leave your job, it may be difficult to supplement or buy that insurance elsewhere at that point in time. So it's something to consider that your policy through your work is not portable. It doesn't go with you. There are some policies that, they may give you an option to opt in to that coverage after you leave, though that process can be a little bit tricky. But it's good to inform yourself just to understand what it is, what some of the trade-offs or the downsides are, and whether you need to supplement with more. And again, two different people can have very different plans through their employer. So important for you to check for yourself and your partner
Read
as
the
you're
fine
thinking
print.
about. Yeah.
Yes.
Yeah.
So thinking about PolicyMe and insurance, do I need to do a medical exam when I sign up?
Yeah. So, if you think about, so if I just step back and say life insurance as a, kind of someone who's assessing risks, whether someone can be insured or not, you're thinking about two different risks. One is like health risk and one is lifestyle risk. And most people are going through a fairly rigorous application process in order to assess whether they can be approved for life insurance. So they are going to be asked questions, let's say, about kind of, maybe your hobbies. Like, are you doing skydiving on the weekend? Or like, are you the person who gets like dropped off on the top of a mountain and goes skiing in like the backcountry? So they're looking for those type of hobbies. Those might cause like an increase in price if you do those hobbies, or there could be some exclusions on your policy. They're looking at maybe your kind of like history of car accidents, like have you had recent DUIs or have you had a complex, like a lot of accidents? And then on the health side, do you have a complex family history? Do you have any recent diagnoses that would, like have you recently had a doctor's visit where you brought, like you're currently under investigation for certain diagnoses? So that's like the first process. Everyone goes through that, and different people use different words. Like, is that medical underwriting? I would say that is a pretty extensive set of questionnaires to get to make sure that you're eligible for life insurance. So 100% of people go through that process. 70% of those get approved right away, no issue, like you're approved. There's another 30% that the insurance company says, well, that's a slightly more complicated case. Maybe you have quite an extensive health history, or you have, certain characteristics that makes the insurance want to dive in more. So for 30% of people, they may ask for additional requirements. Usually those come in the form of two things. One could be like reaching out to your doctor to get your medical records. This is pretty common. It sounds more daunting than it is. It's like we've made it pretty easy. You don't have to do anything. You just have to consent to allow the insurance company to do this, and they'll reach out to your doctor, and doctors get these requests quite a bit. So that's one thing. And then a nurse visit could be another. This is where they're just kind of getting a recent check-in on your labs and your vitals. And they'll actually send a nurse to your home to do this. So that is probably about 30% of people that have those additional requirements. And that tends to be like I'm generalizing here, but tends to be kind of over age 60 sort of thing. Like an older population is probably going through a more
Yes.
extensive medical underwriting. For the average person in their 30s, like all they have to do is that first questionnaire. So just
Right.
kind of answering honestly about any risks like and any history of like health history, and then you should be good. You should be approved for life insurance. So we see about 70% get approved within like 10 minutes.
And so if I do have a pre-existing condition, they might just want follow-up questions. They might just want something from my doctor, or it might be more
Exactly.
complex, but it doesn't preclude me
No, no,
or
no, no, no.
eliminate
We
the
still
option.
see, like, again, we still see 70% of people get approved even past that. So it's a
Right.
really high probability of you getting approved.
Okay.
Some might just have a slightly lengthier process. And again, they're just kind of understanding your medical background a little bit more so that they can be confident and kind of giving you the coverage.
That's really interesting. Now, pivoting slightly, you offer also there is critical illness insurance. Can you tell me a little bit about it and whether I need it or why someone would
Yeah,
think about getting it?
yeah. So as I said before, life insurance is more of that financial vehicle to protect you against the risk of you pass away. Critical illness is exactly what it sounds like. It's like that same vehicle, but it's protecting you against the risk of getting any major critical illness. So the biggest ones that we see covered is like cancer, stroke, heart attack, any cardiac event, that sort of thing. And this policy will pay out similar to a life insurance policy, a lump sum, a tax-free lump sum in the event that you get diagnosed with a critical illness. So the coverage amount people get for critical illness tends to be a lot less than life insurance. Most people can recover from these illnesses. They might need 6 to 12 months off work, but they don't need, necessarily decades of coverage in order to like protect their lifestyle. So we see an average of kind of 30 to 50,000 is what people are adding on to their policies. That just gives you the financial buffer if you get diagnosed with any of these, if you need additional caregiving support, if you need additional kind of support for your kids, if you want to bring in some childcare support during this time. Just expenses that are like beyond what you typically need, like your day to day because you're undergoing this illness and may not be working. There's also additional, you think of like all the trips to the doctor's office. Like there's just so much expenses in these moments. So it's meant for those periods. In terms of who needs it, we see most people add critical illness onto their term life insurance policies when they're buying with us. The price ends up being, it's hard to say exactly, but around the same amount. So if you're thinking about like $30 for your life insurance, you're also thinking about $30 for your like 50K of critical illness insurance. But it's a personal decision. Obviously, given we are in like Canada, we get our provincial healthcare is covering the major costs. It's not like in the US where our medical insurance is private, but this is just for add-on additional financial buffer during these moments of like really stress for a family.
Yeah, absolutely. So I actually want to talk a little bit about the application process. Now, I do know that there's a great quick 30-second quote. I've done it
Yes.
myself. And you put in your information and there's these lovely toggles. If I want less, how much? If I want more, how much, which is but that's just to start, obviously, to get a sense of the costs and what you might be eligible for.
Yeah.
What's the overall application process like?
Yeah, so it's what you would expect. So as you said, like you start off, we don't gatekeep a quote or anything. We don't make you give us your phone number or email just to get a quote. You can go on, get a quote in 30 seconds, figure out, like is this affordable for me right now in my current situation. So once you decided on the quote, you'll be proceeded to check if you're eligible. So this is a non-commitment kind of like 10-minute questionnaire, as I said before. This is where you're going to disclose information to us about kind of your current lifestyle, your any family history of health conditions, and your history of family conditions. For a joint application, so if a partner and their spouse are both doing it together, I would budget like 10 to 15 minutes to do it. If you have a more complex health history or family health history, maybe give it an extra 10 minutes or so. There tends to be, I think there's about 15 base questions. So just kind of like, have you ever been diagnosed with these list of possible conditions? But then if you say yes to one of those, it might ask some reflexive questions. So there's actually a very personalized application. Like
Oh, that's
I think there's almost over 20,000 iterations of said application. So not everyone will have the same application questions. It depends what you disclose as to what the follow-up questions are. Those follow-up questions can take, as I said, a couple more minutes just to give a little more information. And then at the end of it, as we promised, like 70 or so percent will get an instant decision. So once you get approved, I mean, it's up to you. You have basically 90 days from there to decide if you want to kind of pay and get your policy in place. You can do it in the same session. You can have insurance within like 10 minutes and be fully insured and never have to think about it again.
Oh, interesting.
Yeah.
And what if I'm going through it and I'm not sure about some of the questions or the answers? Is there someone I can speak to?
Yeah, that's a really good question. And it happens a lot. Some people are kind of like, I had the flu last week. Should I disclose that? The answer is no. But like, you do get a little bit nervous about like, did I remember everything? So we have a team of licensed advisors who are available, and they are happy to take your questions. They are like, have been through this with a lot of customers. They get all the questions under the sun. So yeah, they are available by email or by phone anytime, kind of like 9 to 5 across Canada. And they're licensed in your province. We're licensed all over Canada, and they can just answer some of your questions. No commitment again. And even when you buy the policy, there's like what we call in the industry a 30-day free look period. So you can also get your insurance in place and then reach out. And if you have any questions or if there's something you miss, you can always email us in and we can get your question or your issue back in front of an underwriter just to get it on your file.
Excellent. And what if I agree with the policy, I sign up for it, and I change my mind?
Yeah, so that's what I was saying. There's in the first 30 days, no issue. Full premiums are returned. After that, you can cancel anytime. You just won't get a refund of premium.
Okay.
So there's no commitment period. You don't have to sign up for a certain like an annual plan or anything like that. You can sign up and cancel and basically get a prorated refund for a quarter of the month in which you've already paid for. But yeah, it's pretty simple to cancel anytime.
So another question people tend to have is, what happens to the insurance payout if my children are the beneficiaries and they're minors?
Yes, so that is really a really good question. People think about kind of how does the payout happen? So what we see as the most common beneficiary setup is the primary beneficiary, meaning the first person in order who would get paid out, is each other if you're applying as a partnership. So no matter what, like you'll pass on that full lump sum to each other if something were to happen. And then your secondary beneficiaries are your children. Typically, people are naming a trustee if the children are under the age of 18, and that trustee will act as like someone just to manage that payout and pay for the expenses they need, but basically hold it in trust for those children if they need it. So on our application, you can actually specify if you want to name I think we actually make you name a trustee if in most provinces if you select someone who's under 18 as a beneficiary. So that kind of is the typical insurance setup. If you're not sure in the moment, you're like, this is very overwhelming, I'm very complex, you can temporarily set like just like your estate This
Yes.
goes through a more complex process, but essentially you can still select a more general beneficiary, and then as you figure it out, like if you want to take a couple months to figure out a more complex beneficiary structure, you can always update your beneficiaries after the fact.
So even if I have one for myself, I say get divorced or split from my
Yes.
partner, I could go back and change it at any time.
Yes. Yeah. At any time you can change your beneficiaries. We see it pretty common if someone has another child, they want to add the new addition to their family as a new beneficiary. So at any point you can kind of adjust that beneficiary.
We're actually going to move to some questions from the people on
Oh,
the webinar. So this is a question actually we had, and so does Maria, and I'm sure a few other people. So what if the term life insurance comes to its maturity? What happens to the policyholder then? And I think this is just a question about, hopefully I'm paraphrasing right, about what happens when the policy ends.
yeah. So ideally, you've set up like your policy in a way that this is the right term length for you. In the first 5 years of any policy, you can convert your policy to a longer term length without going through medical underwriting. So you do have that 5 years. Say you only bought your policy. You bought a 10-year, you're like 40, you bought a 10-year policy, you think like by 50, I'm feeling good. And then a couple of years later, you're like, I'm feeling like I want this to be a little longer. You can extend your policy to 15, 20, 25, 30 years at any point. So that's one option. That's like a term to term conversion. Then you can actually use a permanent conversion. So this is quite expensive though, so I don't want to sell this as like the perfect solution. But if your policy ends, you can always convert it to a T100 policy or like a permanent policy at any point during the life of your term length. So you can basically say, okay, I decided at this point my policy is about to end, but I still want to keep maybe like 50 to 100,000 of permanent coverage. You can actually convert it to a permanent plan to hold on to it. And then the third option is annual renewals. These get pretty tricky. So that after your policy term ends, every year you can hold on to your policy and just like renew the policy for 1 year at a time. But I do want to caveat that gets pretty expensive pretty quickly.
Yes.
So that isn't the perfect solution either. But what we see is most people, by the time they're at like that retirement age around 65, they let it go. It may feel a little odd because you've been paying for insurance for so long and you didn't get to use it. But honestly, that's what keeps it affordable for everyone. And a permanent policy, if you had paid those permanent premiums for that duration, it would be a lot more expensive you during those like very tricky years when like cash is a lot tighter, you're a young family, you're just starting your career, that sort of thing. So yeah, there's a few options if you really need to extend it, but I mean, as I said, like it's pretty common for people to let it go around that age 65 or so.
Yeah. Another question we had is actually, how is PolicyMe different from other insurance companies?
Yeah, so we started the company in 2018 with a mission to make it easier and more affordable for families to get life insurance. This was at a time where the only way to get life insurance was to go into someone's office, to find a broker, and do it face to face, which just, if you don't trust that person across from you, can feel very uncomfortable, and you start questioning whether you're being like oversold or getting a very complex financial instrument perhaps. So we wanted to allow people to like just self-serve the way they wanted to. If they wanted to educate themselves on the process and get advice their own, and be supported maybe in a very opt-in manner versus like a mandatory manner. So we built an end-to-end application that is very seamless. Like you can go through it. There's no obligation. We made it very simple to buy. And then we've started to really make our operations as efficient as possible to bring down the cost of insurance for the consumer. So at this point, we are in all segments, but we try to be the most affordable in Canada. We try and constantly push out places where we think we can make it more efficient to get you insurance and therefore bring down the cost for you. We've done things like include, the first ever joint application in the Canadian market. We add 10% for anyone who's applying together. We launched our free child coverage. Right now we have like a September savings program where you get an extra 10% off your premiums if you apply in September. So we've kind of really just brought a really modern digital kind of no obligation process to the life insurance buying journey in Canada.
Yeah, that's fantastic. I mean, I'm going to age myself, but I
Yeah.
certainly remember having to sit down and it was very hard to find information and dealing with a broker. And then when I dealt with said broker and wanted to make a change recently, they were nowhere to be found.
Right.
It's been a difficult process. So as someone who's loves the digital world as well, I actually find it lovely that you can do this and you can find out how much you're going to get and you can do it at any hour.
Yeah.
which I think these days a lot of people also appreciate, especially busy young parents.
Yes.
It's not always easy to do
Yeah.
this, at 9 to 5. So we have a question. Another question. What is your biggest piece of advice when looking to buy life insurance?
Ooh, that's a good one.
Ah.
Yeah, I think definitely go through those advice algorithms and try and make sure you're getting the right amount. I mean, I think a lot of people make mistakes about over-insuring even. Like they really get way too much insurance. There shouldn't be a situation in where your family are getting way more income if you were to be not here than if you were alive, right? That probably means you're spending way too much on your life insurance. You should not be spending hundreds of dollars on your life insurance. Like the likelihood of you using that policy is pretty low, and you don't need to make sure that like all of a sudden your family has $3 million of income if you were to pass away, if that's not the case, if you were just to be alive. So watch both sides of the spectrum, not just under-insuring, but over-insuring as well, because right now you have a lot of financial priorities and life insurance shouldn't be the one to like really cut into like, you paying down your debt or being able to like afford your mortgage. So, and then the second one is just to shop around. I think life insurance, like it or not, for the carriers has largely become like a bit of a commodity. They're pretty similar, like
Yes.
there's the policy itself is just like a financial promise between you and the carrier. These carrier are highly regulated companies. Like they are holding enough assets to match their liabilities. They are paying out claims. There's not much differences between them from that standpoint. So shop around. Different carriers are targeting different maybe personas or segments. Maybe one carrier is priced a little more favorably for like females in their 30s versus males in their 40s. And so it's worthwhile to like shop around for that rate. It's something you probably won't be like changing that much, but you will be paying for it for 20 or 30 years. So you might as well lock in the best rate you can right now.
All the benefits of youth.
Yeah.
So there was a question also about where can people go to learn more about PolicyMe and about the company. So one of the benefits of our partnership, of Embark's partnership with PolicyMe, is that they are offering our customers additional benefits for signing up. So if you were to go to embark.ca/PolicyMe, or if you just go on our website and you look under offers, there's actually a page you can go to. There's some information and we'll link you to PolicyMe. And by using that link, you get the incremental benefit of being an Embark customer.
Yeah.
And at the moment, PolicyMe has a special offer just till September 30th. And that is where you save an additional 10% on your first year premiums.
Yeah.
Now, everyone's probably thinking, oh my gosh, can I sign up for this in 7 days? You actually just have to go through the application.
Yes.
You do not have to commit. So if you go through the application by September 30th, you'll be eligible for this special offer. So you don't have to commit yet.
Yeah.
And I believe you said it's 90 days.
Yeah. So once you get approved for your policy, you have 90 days to actually take it, and your rate will be locked in, and that discount will be locked in, both the Embark discount and the September savings discount. So
Yes.
they kind of stack on top
Yeah,
of each
so
other.
it's a stacked discount. You
Yeah.
actually get the base discount and then the incremental discount. So,
Yeah.
which is really a great benefit. So again, you can go to embark.ca/ sorry, going back to the questions here, PolicyMe. Also, or if you happen to be logging into your Embark account, there is a tab that has our offers, and you can link there as well.
Cool.
And I think a lot of our questions were about, you know, we had a lot of questions. How do I make sure I had enough for a kid? So it sounds like you've got there's online tools. You have some on your website that someone could use. There were a few questions here around fees and performance of the life insurance. And I think that's more talking about a whole life insurance product, which is not PolicyMe.
Yeah, so we strictly have term length. So we strip out all the investment components from these products. We're trying to just build a product that's simple, that makes sense for most Canadians. So when people are asking about like investment performance or additional fees associated with the products, they are probably talking about a more complex, like universal life type product.
Right.
And so those, again, they have their value. Typically, when you're thinking about some tax saving strategies and things like that, they tend to be more popular around kind of like in older ages when you're thinking about estate planning and things like that. But it's not one that we recommend for people in their 30s. It can be very expensive into, hundreds of dollars a month that you're putting towards life insurance. And if you're not even, maxing out all your kind of savings plans already, like all these government programs that you could, your TFSA, your RSP,
Your
RESP, like it probably is not the time to start having a very complex investment linked life insurance policy yet. It's when you have maxed those out and you've kind of optimized your tax strategies that way, that you probably start to think about more complex life insurance policies. And yeah, that's not something we sell right now.
Charles is asking, can I get insured at 56?
Yes. Yeah, we insure all the way to 75. My team needs to keep me honest, but I'm almost positive. So yeah, 56, I think you could get either a T10, a T20, and probably
term.
term 10, term 20, and a term 100 if you wanted a permanent policy on our website as well.
Interesting.
Yeah.
And then we also have a question, and this is an interesting one too. What about life insurance we have with a credit card and line of credit?
Oh,
would you advise to get a separate one?
Yeah, so there's life insurance. You can find little life insurance policies in different places. Some people might recognize mortgage insurance policies, which has a life insurance component to them, credit insurance. Typically, if you're buying those products, what they're like in this category of life insurance that's called simplified life insurance, which means minimal underwriting. The trade-off when you're not willing to do some underwriting, and again, underwriting is like a 10-minute application, is that you're typically put in like a higher risk pool and therefore are charged a lot more. So mortgage insurance compared to like a fully underwritten medical policy, like the ones we sell, can be like 3 times the price. And people don't know because it's just so easy to get it. But if you actually start comparing the costs you're paying per $1,000, you might find that is just like unaffordable, and you can replace it for a medically covered policy for a lot more affordable. The other thing with some of these policies like mortgage or credit card linked policies is that they might have that same issue as your employer policy, where they're not portable, like they're only 5-year terms, or if you ever lose that credit card or like leave that credit card or switch mortgage providers, you might lose the life insurance. And at that point, things, your eligibility for insurance might change, and it just snowballs into like some of the more scary territory. So yeah, it's worthwhile. Again, it's the same. I don't have a blanket answer, unfortunately, but it's worthwhile reading the details. And then, as I said, shop around, make sure you're getting a good price on that, because some of these easy to apply ones that only take a minute and don't ask you many questions typically come at a higher cost.
And a mortgage insurance, or in some cases, a balance protection, which a lot of you would have for a lot of lines of credit or credit cards, they cover the balance on your mortgage or the balance on your line of credit. So that amount goes down with, so if I'm close to paying off my mortgage or I'm halfway through my term, that amount is going down.
Yeah.
So, and I'm not getting anything
Exactly.
extra. The mortgage will be paid off, which I think we'd all like, but I'm not getting anything additional. It's not like if I sign up for $100,000 policy, no matter how much I owe to anybody, I will be getting that 100,000, or my beneficiary would be getting that $100,000.
Yeah, exactly. And some people appreciate more the flexibility of getting the lump sum versus it like just paying off your mortgage, because it's like, maybe I'll still pay my mortgage, but I want to like like I want to use this towards other expenses. So the lump sum is just kind of, it's there, you can use it in different ways. It doesn't have to be so linked to like the debt that you own.
There's a question here. It's interesting. I'm interested in one that allows me to release funds to my child in a special situation. Who can I talk to? Is that, I wonder if that's a trust type?
Yeah, this starts getting into these more complex products. So technically, when you have like one of these whole life or universal life, given you're overpaying for the insurance, right? So you're maybe at 30, your cost of insurance is only $30 a month, but because you're paying $200 a month, some of that extra payment that you're paying is going towards this account, this investment account that is going to accumulate money over time, and then it will slowly start like draining money when your cost of insurance gets more expensive than your monthly payment. It's slightly confusing, but in the later years, when you've gained some money in that account, you can take a loan against it. You actually can't pull money out of it. You take a loan against it. That's what allows it to protect its like tax eligibility status. But you can take a loan against it and use it for other expenses. Again, this gets into pretty complex territories. If you're looking to like, save money for your children, there's other vehicles, RESPs, other savings vehicles that may be a little more flexible for you than a life insurance policy. The life insurance policy can have a lot of caveats as to how much you can take out and when you can take it out and things like that. So it's important to be super informed before you get into some of those contracts, because they tend to have very high lapse rates in the first couple of years once people realize it's not this perfect vehicle that they thought they were buying into. But by that point, they've spent hundreds of dollars a month and just can't get it back. There's no clawing back any of that money. Yeah.
So we're wrapping up, and I think we've answered most of the questions that have come in. Is there anything you'd just like to add at this point?
Yeah, I just think it's like, I mean, it is technically Life Insurance Awareness Month, but I feel like every month has like some random other theme to it. But yeah, I think it's like great that you guys are like trying to inform yourself and educate yourself about these products. They are very overwhelming, and for most people it's new to them, right? They don't know where to look. So one is just like props for everyone for even attending this. I think that's awesome. But like two, keep digging, go test out our quotes, go just read some of the blog articles that we've like co-produced. Like there's a ton of content out there to inform yourselves. And I think just make sure you know what you're getting into, and that, you're checking these things out. But I think everyone here has already taken like the first step. Is awesome.
That's fantastic. Well, I will mention to everyone listening that Embark's going to send out an email in the next few days. So it'll give you more information about how to get the promotion, where to go to learn more. Obviously you're welcome to go right now, but that will end up in your inbox if you get, but we really appreciate everyone joining.
Yeah.
This is part, I think, of Embark, we care about your children, your RSP, but we want to think about this as a holistic approach to helping protect your family's financial future, both through education savings, but also other things that are, with these wonderful partners who can help us learn about it, because it is daunting.
Yeah.
Whether your children, you're young or teenagers, it's a lot, and
Yeah.
there's a lot of share of mind. So it's great that we have companies like you helping make this simple or
Yeah.
to help simplify it. So thank you again.
Awesome.
We
Yeah,
really
thanks for
appreciate
having me.
everyone who joined us tonight.
Thanks, guys. That concludes the end of this webinar. Thank you all for coming and attending. Again, to Julie's point, we will be sending out an email shortly. Yeah, I hope you all found this very informative.